Welcome back to another video. Soel here, and today I want to talk about Relative Vigor Index, or RVI for short, which is an amazing indicator for measuring the power and strength behind the price movements. Make sure you watch this video until the end because I'm going to teach you how you can effectively use this awesome indicator in your trading strategies. Alright, we have RVI indicator here below the chart. It's actually an oscillator, and as you can see, it's moving above and below the center line, which is 0. This indicator is commonly called RVI among traders, but on TradingView it's abbreviated as RVGI because another indicator is abbreviated as RVI. In this video we call it RVI. So by RVI we mean Relative Vigor Index. The green line is RVI line and the red one is signal line. The default setting of RVI on most of trading platforms is 10 for the length, and this is the one used by most of traders, but depending on your trading strategy or the time frame you're trading, you may need to increase or decrease sensitivity of this indicator by decreasing or increasing of the length. The formula and calculations behind these lines is a little complex and difficult, and I don't intend to get into the calculations of Relative Vigor Index in this video because in practice you don't need it and it's already available in most of trading platforms. You just need to learn how to interpret it and use it for trading. Anyway, if you're curious how it's calculated and you want the formula and calculations behind this indicator for any reason, just simply search in the Google and you'll find it in many websites. Alright, now let's see how we can use this indicator for trading. Being an oscillator and moving above and below the center line, one can use this indicator for identifying overbought and oversold conditions of the market, but it's better not to use this indicator for this purpose because this is an unbounded oscillator and it's not designed for this, and there are much better indicators for this purpose like RSI, Relative Strength Index. So we don't use RVI for discovering overbought oversold levels of the market. We can use crossovers or divergences in these situations, which I'll discuss them later in this video. And another important point about RVI is that it works best and gives the most reliable results when the market is trending. So you should never use this indicator in trading ranges because you will encounter many false signals. Two of the most common use cases of RVI are crossovers and divergences, which I'll explain them now. Let's begin with crossovers. When the RVI line and signal line cross each other, they can show the turning points of the market. When the RVI line, the green line, crosses above the signal line, the red line, it gives the signal that the price is possibly going to advance, and when it crosses below the signal line, it gives the possibility that the price may decline, and the probability of achieving the expected result is higher when RVI is far from the center line. But as you probably know, crossovers are generally very prone to be false signals, and you can see that after these two successful signals we have many false signals. Each of them somehow show a turning point of the price, but not all of them worth of trading because they just show some pullbacks and temporary pause in the movement. Or here in this part of the chart you can see that this bearish crossover didn't turn out to be a reversal signal, but after that this one was the case. So please pay attention that these crossover signals must be used in conjunction with other tools. Taking reversal trading signals that are actually against the current direction of the market has higher risk, and the best way to use crossovers is taking the signals that are in the direction of the current trend. So first we identify the current direction of the market, and then we only take the signals that are in the direction of the trend. For example, in this case we only take the bullish crossovers because the trend is up, and we ignore the bearish signals. By doing so we lower our risk for not being against the direction of the market, and will be sure that we're entering in the direction of the current trend after every pullback. A better signal that we can get from this indicator is divergence. A bullish divergence forms when the price makes lower low but RVI makes higher low, which shows that we have less downside momentum and the upside momentum is gaining strength. This gives us the signal that the current trend is possibly ending and we may have a reversal. Please pay attention that having divergence means that the current trend is weakening. A reversal can happen and the price may turn to an uptrend like what happened here, or the current trend may end and the price may go to a trading range before proceeding in either direction. So generally having a divergence means weakening of the current trend. And please pay attention that when the trend is strong we may have a divergence or even some consecutive divergences but without any ending of the current trend or reversal, and the price may continue its overall direction, and the divergences may only foreshadow corrections or pullbacks. So even with divergences you should use these signals in conjunction with other tools and aspects of technical analysis for confirming your trading decisions. And bearish divergence forms when the price makes higher high but RVI makes lower high, and this shows less upside momentum and indicates that the downside momentum is gaining strength. This gives us the signal that the current trend is weakening and the trend may end and possibly we may have a reversal. And similar to bullish divergence that I just explained, the divergence doesn't necessarily mean reversal instantly, and when the trend is strong we can have a divergence but the price may continue its overall direction, and the divergence may only foreshadow corrections or pullbacks. Relative Vigor Index is a very effective tool for evaluating momentum and identifying changes in the direction of the price, but like any other tools in technical analysis, you should never take your trading decisions only based on this indicator, and you must use it in conjunction with other tools and concepts of technical analysis. Alright, that's it. Thank you for watching this video. If you have any questions, feel free to ask and leave a comment for me. I'll answer your questions as soon as possible. If you haven't subscribed to my channel, please subscribe and hit the bell so you get the notifications of my new videos. See you guys in next video and good luck with your trading.